Thank you everyone. We start with our first session. We have our CA Abhyar Gunte. I request you to kindly join. Please welcome him with the round of applause. I request this one to kindly complete the welcoming and presentation of our speaker.
Abhyar Gunte is from Pune. Though he looks young, but he is intellect and significant now. We had He is from Pune, though looks very young, but his intellect and income is very deep down. I will believe his intellect and income will be better going forward like yesterday. Thank you so much. Do you want to connect that with it? Yeah, I can do that, but I need a connector.
Okay.
For HDMI.
You have? Not an issue. Then we'll put it over here. Give me a minute.
Hello, it's audio. Loud and clear, right?
What's the middle? Huh? What's the heading? Huh.
Good morning, everyone. Okay, thanks. See, everyone did amazing, and the rain campaign did not spoil the movement. I hope you are looking for the right messaging, and very interestingly, the topic that has been chosen is about income tax. I hope that after the meeting, being contacted by other speakers for last 2 days, I have been a strong speak today at the RRC. So, compliments to the organizers for taking bunch of topics. And the topic for the morning today is evolving international tax students and the takeaways for the businesses. There is a reference to the Vodafone judgment which happened almost 40 years back. I kept wondering why it is when they started developing part of the data. I found some interesting threads which are not pertinent to the time judgment which came a few months ago. And I could only see that having tracked the report and other factors, the regular certainty is speaking. There was a period when Azadi and there was a moment in between where authority for advanced meeting with international tax matters was giving judgment mostly against the taxpayers, and now again in the last 4 or 5 years, you would have seen most Supreme Court judgments. There is a particular tendency, there is a particular approach that judges are taking. Judges are not merely looking at judges are not only looking at the commas and or and to interpret a very fundamental provision, and that is a very shift to be guided to the judgment. In an example, we saw the 147, 148 ESOP proceedings, how Supreme Court revived and gave a audit branch to the tax office. Same with the higher the next one. One standard exception, however, continues to be the taxation software, for which at least so far the Supreme Court is in favor of the taxpayers. Like I mentioned, title global judgment followed by that's a full scheme that we will look at legal and financial provisions, and then followed by the judgment around the corporate establishment. And there again is a very interesting shift on how courts are looking at the traditional fixed place fee concept over expansively. Software is the third one, MFN, most favored nation. This is a much controversy where there is again a big upside on the change in the view from the Supreme Court. Many of us for the last 20-30 years have been taking a view applying everything that is of providing case was accepted by everybody. And when you push the administration of the law to very, very extreme limits, you get a counterproductive outcome, which is what happened in case of dividend, and now even the royalty case is has been upside down. So that's a very important change from practice standpoint. And last but not the least, software taxation, we will look at. I have about 60 minutes time. I have at least 4 or 5 things. What I promise is that I will not rush. I will cover the discussion. Whatever we cover in 60, 65, 60, 70, 50, we will do that. Remaining slides are there. You all have been in practice for several days. You can also reflect on some of these points. So that's how I'm going to base my presentation. Short diagrams that are people, advisors. I also run a AI startup. Earlier I do only Taxation B2B content portal. I work with everybody at a chamber of taxation, and they have the general committee of the city. So if anyone of you are interested in write articles, do reach out to me. For the rest of the same talk I'm doing for chamber, so that we get some wonderful offers to capture us like contributors. I've been mostly tackling some of the OECD projects around the best. The sales inception in 2010, 11, 12. And the reference, before we go into the technical session, I go to my colleague, and one of them put together these nice looking slides with portfolio between. So, Vodafone to Tiger, that's the journey. I was presently Supreme Court for about 3 years in the Vodafone where it happened. Within the argument by itself, Rohit and Nariman today went on to become the judge at the Supreme Court. Nariman argued on behalf of the government, and it was very interesting. He saw over the course of 28 days in the Supreme Court. Just to say the context, Vodafone deal happened in 2007. About $12 billion sale. You all know the facts that Hutchison, the Hong Kong company, sold the stake in Mauritian companies, which were into Cayman companies to Vodafone. Remember, Vodafone was the buyer. They did not make the money. They bought the shares. Money was made by Hutchison, but tax department went after Vodafone because they wanted to income, but it was easy for them to go recover the taxes because Hong Kong and that kind of thing are the tax regime. India, so there was no way India could have gone again consistently recovered the money from the gain. They went after overload import 195 CA provisions and say that when you pay state consideration, you should have deducted the tax $2 billion and 2007, when the Bombay High Court was in favor of Vodafone and Supreme Court, I think it's very rare that in a 5-year period from a transaction to the Supreme Court, they have after that means again India, it otherwise takes at least 20 years. It happened because there was some very high profile people involved to which made it happen. So that's the controversy we all know. This is Kapadiya name that it said look at principle Azadi Bachao. The Supreme Court also was made by the fact that there is job creation in India, which Vodafone created a capital that they introduced. So that's the philosophy that the Supreme Court considered while looking at Section 9. Provisions have been worked and said that for indirect transfer of assets taking place outside of India, there is no prices of shares in India, therefore no tax in India. So that's what we know. Then in 2012, the EPA amendment which created the body of tax terrorism in India and in fact Mukherjee was the finance minister at that time. He was very pushy about this amendment. The 2012 retrospective amendment happened. India got the tax terrorism sort of a badge when it came to the tax policy. Then came a very interesting question against some of the Andhra High Court, because it's sitting in Andhra. This is the case where again there is the indirect transfer, but the indirect transfer happened from one French company to another French company and selling shares of another French company. So, like Vodafone, there was a overseas structure and two non-resident taking the shares from another non-resident company. But the key fact was that here there is a treaty available, the India France treaty, and a French resident sold the shares of a French company which eventually had the part of business of Monopoly in India. So at that time the interpretation was that this is an indirect transfer clearly covered by the tax treaty provisions in the India France treaty, and therefore no taxable from India. Another High judgment. 2017, the indirect transfer provisions got further sort of diluted. This is also the time when VAR was introduced in the statute as well as actually VAR was introduced as against the judicial VAR. In between, we all know short committee happened, grandfathering happened. Between 2017 and 2025, just to point out the Vodafone initiated bilateral investment arbitration, treaty that India had, saying that what India did was going back after Southern Province, later to again the bilateral investment treaty, and therefore the proceedings were initiated. Finally, in 2021, government rolled back the application of the retrospective effect to the law. To summarize, after all this litigation, India as a country becomes the latest single claim from Vodafone transaction. I mean, all the lawyers actually concentrate on over a 15-year litigation that we took. But anyway, that was necessary from our tax policy clarity standpoint that this amendment happened. And then, 26, we have a title global judgment. So, we have indirect transfer judgments, indirect transfer without treaty, indirect transfer with treaty, and now we have a title global judgment, which is the other end of the pendulum, where there is where Supreme before this, let's give Vodafone. Tiger Group, let's come to the Tiger Group global judgment of Supreme Court. So here, I'm sure all of you have read enough on this, but just a quick refresh of the facts. So we are talking about Flipkart India. Flipkart was held by Flipkart Singapore. Flipkart Singapore is held by a few Mauritian holding companies. Then again there are Cayman and Mauritian holding companies. And Tiger Group is among the top 10 private equity American headquartered structure. And Walmart Group, which is in USA, they through its Luxembourg entity bought the shares in Flipkart Singapore. So the transaction is that Mauritian entity selling the shares of another foreign company from Singapore to a Luxembourg entity. So here again there is an indirect transfer provision. The value is coming either from the Flipkart deal, which happened in 2018. The only difference over here is that the seller is a Mauritian entity. So we all know that if the seller is covered by a tax provision, treaty provisions are beneficial, they won't apply. This structure was set up before 2017. As you know, in 2017, India Mauritius Treaty also got amended, which said that past investments under the Mauritius Treaty will not tax. Future investments over the 2-year period, then the investment would be taxable in India. So this transaction did take place after the amendment of 1st April 2017. This transaction also took place after Rule 10 and GAR grandfathering under the Indian domestic law came about. So GAR amendment specifies that past structures or past investments may not be subject to the GAR. That's what the Rule 10 provisions also state. Now, this from 2018 to 2026, again 6-7 years, we have came out from the Supreme Court. They actually filed a bill withholding tax application, and then AR also ruled against the taxpayers saying that there was a prima facie tax evidence. Delhi High Court gave a judgment in favor of the taxpayer in 2024, saying that the benefit is available over here, and then the matter went before the Supreme Court. Now, what are the key facts that the Supreme Court looked at while delivering the judgment? That these entities in Mauritius were set up with the primary objective of undertaking investment activities, long-term appreciation, and they were the taxpayers' intention. They were regulated Mauritius in environmental entities, OECDs, there's not a tax haven like regulated. There was a board of directors and a Mauritian company, 2 Mauritian presidents and 1 US president. And most importantly, the tax residency certificate. Verification takes place between the insist on a tax residency of 10. And so far, the understanding is that the tax residency certificate is operational. We are seeing no further question. Azadi post Azadi Uchama in the context of FII, then now yes, government and government department have been mobile saying that if there is a tax certificate, we will accept it. It's not the case here. They were registered functioning with the tax residency certificate. But here comes the twist. What revenue argue is that they were investment holding vehicles, but they were treated only for the tax benefit. The primary purpose was to obtain the tax benefit. How many of you treat Mauritius today? My experience from the airport to the city center airport to our driving, I probably see beautiful people and between some beer factories for almost 90 minutes of drive. It's only the last 15 minutes that I saw some nice buildings, high-end homes building and we had always plus from offices with hundreds of companies listed as a registered office. I don't want to pass any judgment. India accepted this the way it is, but now we are questioning the substance of the anyway. Department argues that this is only for the tax benefit. The key investment decisions were driven by one US-based person, this Colman. So there is a board of two Mauritian residents, but these are local professionals. And one person from USA who would come for board meeting, attend and go back. He would spend most of his time otherwise sitting out of US, taking the key decisions. His environmental principles are activity. He was also named as a beneficial owner in the company of residence at Mauritius, which is what revenue RRC. The back account control. So, who was the secretary to the Mauritian bank where the money was collected? It was this US person and other employees of the US entity. So, they say that you call yourself as a Mauritian entity, but you are effectively being controlled by the US people. The meetings of the board meeting did not show any deliberation, but here a ratification or noting of the investment approvals. This again was an important factor that we need to look at. Now, let us pause. We all know what the document has made and so on and what are the effects. What are the takeaways for me? Today, I think tax administration has not gone aggressively after the ways of fiscal management for considerations. Of course, tax rating and sale of capital substance is one key aspect. But all of these considerations are relevant when it comes to the point analysis. We have a lot of detailed groups where there are audit facilities and many of us either review or get the minutes of the board meetings. We say that from a point standpoint, board meetings after we have promoted traveling on vacation, no one board meeting, etc. But this is what Supreme Court said, that who is actually controlling the bank accounts, who is actually, what are the deliberations that are taken place. So these are not takeaways according to me of the judgment as to how revenue is attacked, or what is the analysis and how as we professionals need to sort of keep a documentation to justify that I did actually take the decisions and I had people to take the decisions in whichever jurisdiction I operate. So, yes. Yes. So this question is Mauritius basically operating for doesn't operate in the market. That's a question, right? So yes, I mean in this particular facts, Supreme Court said that practically there is no tax avoidance and therefore the tricky benefit is not available. There were other layers also from a legal standpoint that were added. So the way direct approval now will play out is that we would have said that practically that's important because against EIRC we do Delhi High Court taking EIRC said that there is a practically that's important. It's sort of confusing too. In my view, direct approvals they have more theoretical chance to present the facts that what are the deliberations that actually took place. I don't know how to create a record for all this now because everything is on the record before the department. But to answer your question, if it is a paper activity, which most of the cases is, but I can give you around maybe one because that data is the complete record. ESOP has a massive setup in Mauritius. To build a substance, they actually shifted people from Hyderabad to food on to Mauritius because it is a substance in Mauritius. So, some people have actually tried to make an effort to build a substance. I think they will stand. Others will face a systematic party. Now, in this case, like I said, there are various layers in target global. Target global is also a indirect transfer provision, not a direct transfer provision. So that made, so there was the eligibility and the application of rule 10Q, which gave a grandfathering, made that much more difficult. You could have structure where there is a direct body also in 2017, in which case you can have at least one difficulty of indirect transfer interpretation that is gone away. So, to answer your question, yes, most will be affected, but not all. Many will be affected, not all. One of the key arguments, this is the Article 13 of India Commercial Treaty. Clause 1, this is the taxation article. Alienation of equal property is not applicable. Equal property forming part of the that is not applicable. Then other gains of alienation of shares acquired on property is taxable in India. Pre-2017, 50% rate. And Article 4, gains from alienation of property other than square foot shall be taxed only the contracting state in which alienator is resident. So, Mauritius sold shares of Singapore, therefore, the argument is that this is there is no taxation right to India. Now, what were the key conclusions from Supreme Court? The first conclusion is that Article 34 exemption is applicable only to direct shareholding. This is one of the arguments of developed, which is the point that I mentioned. Direct transfer is a bit more difficult. Though plainly, 34 government use the indirect holding, but Supreme Court said that this exclusion only applies for the direct transfer, not indirect transfer. So look at the irony. Vodafone said that indirect transfers are not taxable. There is a law that say that indirect transfers are taxable in India under the domestic law. And now Supreme Court is saying that the original treaty benefit is not applicable to the indirect transfer but only the direct transfer. So it's like a double whammy for the indirect transfers, so to speak. Third point is this is important. EIRC is not recommended, but it is recommended, but it is not the only criteria to grant a treaty benefit. Now this again, from a practice standpoint, when we reach to form treaties, we take benefit EIRC as the final rule. In my level calculations, I think at least from profit standpoint, we ought to make an effort to see if we can get some comfort from EIRC. And post agriculture in the news, you would have seen that notices have been issued to the large private equity saying that tell us beyond EIRC, from a substance standpoint. So I think those who are in litigation here in High Court and tribunal, this will be a one area of litigation where more notices will come to. The overrides DTA, this is the key conclusion. This is again an observation that actual taxation in the other state relevant from a treaty standpoint. It's an orbital in my view, but not a key conclusion, but this is what again Supreme Court said. And rule 10U safeguard. So rule 10U gives a large grant for the investment. Supreme Court said that it applies only for the investments made prior to 2017, but it does not automatically implement the transaction if the transaction is an avoidance transaction. So this is either making rule 10U slightly too less, at least Supreme Court interpretation this way. Now, after the judgment, also a lot of action has happened. One of the key points is, this rule 10Q, when there was a lot of concerns expressed by the foreign investors. So, there was a press release that was issued. March 2026, rule 10Q was again amended. Because of clarity saying that bar and for the provisions will apply. That shall not apply to the income of the maximum investment made before 2017. So we have some relief coming through at least on the 10 that 5 lakh for pre-2017 investments. Government is saying that we will not accept. Those cases that have already started where there is an adverse order, we have to say because this came in March 2026. So what are some of the important takeaways? Like I said, from a foreign standpoint, the commercial capital sector in the operation management, profitability, predictability was an important aspect that was key. So, I think we have, from a resolution standpoint, what were the decisions, what were the people, what did those people actually say, those deliberations of more elaborate ways would actually quite important with them. The rule of headquarters is one important thing, just showing that anything happened on the West went again, like over in this judgment. Now there are two important aspects from a legal standpoint. One is on the tax establishment. This has been a key point that in negotiation, one is that you take a final conclusion, but then parties that you are negotiating will negotiate that if tomorrow something goes wrong, you will bear the risk. And let's agree on that, which is what pretty negotiation partner is. I have seen some of the private equity players even before Tiger Global were not taking a very aggressive view for the ownership transfer. So from a risk allocation standpoint, if I am a seller, of course, primary responsibility is on me because I have no income and a position, but I can always take that position through the income that is returned and find it out. But a payer or the buyer of indirect transfer shares, he has a tedious risk, and to what extent he is willing to bear the risk is becoming more crucial from a contract standpoint. And last but not the least, the M&A deals, tax insurance from M&A deals is one growing field. I have seen some of the large game-changing insurance transactions like Tiger Global Insurance is saying that yeah, if I have a person for the previous obligation, then I get myself insured, which covers my litigation cost and the worst case scenario, my tax risk as well. There are funds that are available for large transactions over here. So this is one key takeaway from this evolution of Vodafone to the Tiger Global. The pendulum around the EIRC transfers has swung. I'll pause here in case anybody has any reflections or questions, and then I'll move to the next slide. Yes. So if your opinion, what is the question is that EIRC is not sufficient for the people said, so what more we should do? And all of this so see, we have to see the quantum of the transaction. I mean, many of these many times they are transactions. I'm not giving any value treatment, but this is what I follow. Couple of $1 million transactions, 20 lakhs. I think EIRC said no declaration. It's very sufficient. I think when you have a few hundred millions and billions, when there is a transaction, at that time, I mean, theoretically you should see everything, but it is not possible. So only when some of the large value transactions are happening, I think we also insist on some diligence around what's happening with the time of those. And there, after point, if you are actually working with the structure, suggesting the safeguard around financial documentation. See, this is only because the Indian promoters, they investment company खोल देंगे, investment company खोल देंगे. After that, we go there. There has to be some outside professional clear mandate that you must have once a quarter. Push the increase down. And during that physical difficulty, this is what I am telling my Indian promoters. आप जाओ and you show what meeting on that and whoever is the professional. Idea is you can put people once एक becomes large, that's idea. But कुछ नहीं तो at least more करो. Having nothing is a column more dangerous. So to answer your question, for routine EDS transactions, quite frankly, beyond this, you NFT during conferencing, but EIRC plus a movie declaration, plus a local bank account, before I sleep on every single transaction, it would become impossible. But I will think department of where we got to go ahead and take every transaction to the money needed. I mean, that's a frank answer. If you don't even technically correct answer. But yeah. प्राइवेट लोगों में ESOP में मैनेजमेंट का कोई इशू आया नहीं है, but this is a takeaway for me from this exercise that they went to such an extent to this exercise. OM is one thing where I saw only one news about OM being questioned in the last figure. That one was financial ruling in favor of the taxpayer. But I'm not sure if that's what is. Has anyone here faced the point ever to us? Okay, so only one in this room. I think in the next couple of years, what Tiger did not need to know when issue. Department did not challenge point. And which is what I'm saying that ground to hopefully they come out and good. Maintaining this point from a factual standpoint, but it was from a TTN standpoint. That point was because the consequence of doing it is that Mauritian company is the resident of India. Then your TT fails, if you are resident of India. So that department has not looked at that in life. Moving on now to Formula 1, the P element evolution. Even before, so permanent establishment will be evolution. Just to take the context for non-residents, you all have studied Article 5(1) of the tax treaty. It says that a foreign company carrying out business takes place situated in a source country, then permanent establishment will be considered. Then there are other things, agency permanent establishment and service permanent establishment and so on and so forth. But the traditional model since 1920s have been the fixed place fee. Of course, OECD therefore will be saying that fixed place is not the only criteria. India then therefore came up with significant economic presence in the domestic law, which is not necessarily fixed fee. But this is the domestic law. Tax fee still says fixed place permanent establishment. Now, what is fixed place fee? We all have learned the evolution of fixed place. It means that you have a fixed place which is at your disposal and through which you carry out your activity. If a bottle of if a design studio sets up a project office in India and they make that project office for a period of 12 months, people from overseas come to that project office, work out of that office and deliver the work to the Indian clients. That is a classical fixed fee, where the foreigner has a fixed office through which he is carrying on the work. And that fixed place is available one is the threshold. So this is how we eventually looked at pre-related products. Now, they all know that the way around most of work is happening, physical presence is not necessary. People hardly travel, remote working is not common, and therefore, wherever fixed place article 5 principle is relevant to today's context, that's more fundamental with at the OEC level that's happening. Now, while this concept was evolving, we got one sort of a shock from the Supreme Court to the formula of the judgment. This came in 2017. 2017. India hosted the formula raised in 2012 just for a year, just a meeting Noida. But the formula raised so India is first company for a year. And Formula One, as you know, is a very timely. The whole IP belongs to this Swiss company. Then there was a chain of UK companies, and then they entered into a contract to change the sports in India to say that there is a circuit that's available. That circuit for the next speed is exclusively available with Formula One. It was a Iranian operator, which is several other countries. The key argument before was that there is no government establishment for the Formula One in India because the circuit belongs to JP. Formula One said that I don't have control on that circuit. It belongs to the team. Also, it's a 1 week race. So, when the 6 months record. So, this race to be is not satisfied with the primary argument that Formula One took. So, what are the factual findings that the Supreme Court has looked at? Is that this economics control the circuit during the limit period. So, during that 1 week period, UK company actually controlled the circuit for all practical purposes. All the substantial rights and control was with economics is the Formula One versus entity. Access to the circuit was restricted and controlled. So, the entry, exit, etc. The people were physically present. It was, this is important principle. The presence was temporary but commercially continuing because what they said is that Formula One doesn't happen. I mean, actual race happens in weeks' time, but over a period of last few years, even the content from outside finally contributed into that 1 week of race, and that's what is the crucial for that business or that event, which is what Supreme Court looked at. And simply it's what we conducted without the approval. Some of these states also go over into higher judgment as well, which we will see later. And therefore Supreme Court said that at the disposal test is satisfied. Duration is not conclusive. I mean, to make money in the 1 day race, that's what matters. 6 months is not relevant therefore. Commercial substance and economic reality. This is a common thread in direct global judgment. This is a common thread in higher judgment here as well. Attributes of being, of stability, productivity, and dependence are satisfied reported to the vehicle, and therefore there is a movement in the This was the judgment from Supreme Court in 2017. 2024, higher judgment also came about. Now, I explain the facts in brief. Higher hotels, as you know, higher is a global chain. The real estate is owned by the local owner. The local owner typically divides up any franchise industry is higher. A franchise is an operator. So there is a typical agreement between the owner of the building says that I go to hire and say that year after you know the operations, we are there are ownership growth. Equity is owned by me, but the operation within this contract of finance, you do the state, you do the execution of the hotel, you make sure that the food is available, food beds are available, etc. That's a typical model to solve the model for what is things are working in India. So IRC entered into a contract with the Asian hotel. These are the two hotels in Delhi. One is the some places where you go for driving to Delhi to stay there. There you can see Delhi and Mumbai. So there was a strategic fee agreement and a strategic oversight agreement, which effectively said that I have said that I am the boss here. You own the place for everything else over here. I will carry out. I will send my people to your company growth, but you will give them all the costs. All the revenue that you collect into the bank account, I operate the bank account. I will keep a control on the expenses. What I want, as employee application is I want a fee which is percentage of profits and percentage of revenue. That was the key component of the regulation. So there are two exceptions. Legally you collect everything, but I want my share. That share was determined on performance, revenue, and the profitability. I am not basically controlling the bank account and taking all the operations to the places and the hotel. This, in a normal case, you would say you need to pay royalty or a fee, technical fee. In this case, there were interesting aspects as I see from the practical standpoint. I have here taken offer this as free for technical services, where India really does not have an article on free for technical services as well. They also did not offer it as a royalty for higher advantage. They need to position that nothing is taxable. Whatever I get from India is not taxable. This was their position. Department said that, oh, but for a royalty fee, the royalty exchange, we are saying that you have a permanent charge because you effectively are running the hotel sitting on Dubai, in India, and that's the key. So, what are the key factual points? And I think these factual aspects that the conclusion, they have a continuing enforceable right to enforce the policies and ensure the compliance. Consideration for the form of revenue share, not the fixed fee contract. Long-term control, it was a 20-year contract, which made that with a reasonable continuity of operations. It was not a temporary auxiliary activity. Frequent and regular visits by the personnel. So what they saw, they actually took a download of the visits made by higher people with long program. Said that effectively, even though 1% did not stay for 9 months, collectively, the people are coming and going, that threshold exceeded more than 9 months until the treaty. Also, its control of property hypothecation. This was also an important aspect. As I said, the real estate, the hotel building itself is also Asian hotel. But the contractual clause said that if Asian hotel is going to ever hypothecate property, take a back loan for Asian property, you needed a NOC from there. Basically, I said you cannot raise money against the property without my consent. This said is nothing in a way control of the property as well. And with this, fire is said to allow permanent establishment in India. In the legal jurisprudence both practice law, there are several communities both that way that some technical aspects were not right. There is some window available from the legal remedy and particular things happening. There is not making reference to High Court, so why, other way to Supreme Court. They will not get into that. The point again over here is that this commercial and functional reality principle is what Supreme Court is saying. While opening that public discussion will be available. So what the takeaway is for me, permanent establishment period decisions there. I mean, this 6-month threshold, 6 plus 3, those things are attended to by now. Extent of the control, physical operational control, these are the key aspects. I think when you are developing the litigation strategy, sometimes the 10% ES can be a better approach than only and fighting out the litigation. If you get a tax credit, the whole situation, can look at my tax solution. Of course, the Dubai and IRC Dubai was not paying taxes, that's why they took no PA position in India. Of course, now, after all of this, one big open question, RRC is what is the profit to find more government establishment? I have put 7% as revenue share, so there will be a more profit than 7%. This is another question. So, of course, the 7% is now taxed at 140% tax expenses. And this is one more thing that this significant economic recession concept is being pushed as a United Nations model framework as well. The World Committee work obviously very similar. Either one government still has not taken off the ground, so OECD is still holding the force of fixed place, but if any of you will try this remote working corporate establishment, people today, people work on employees work on site. Some of these golden visa countries where you can live for a month for a year and work. Often you take 10 companies, people are, you don't need to be physically present to do the particular work. So sales it to be one country and so there is this growing tendency to apply significant economic presence kind of a concept to the TV. There is one particular IIT judgment in the context of India where they actually have discussed the concept of a virtual key. To give me an advice to an online tool as well as also regarded as a virtual key. So the takeaway information of key in practice is that don't go by the legalistic definition that is very clear that this is relevant from coming to the ground area in CSCT, especially if I am a player and I don't have the legals of the equal recipient. I normally rely on the no P certificate that I have obtained. I am suggesting addition of new clauses to the TE to bring this about the principles of the Supreme Court judgment. The no P area is because the thing that I don't have P as per Article 5. Ideally, I should ask that Article have a significant economic presence in India. That is what I put as a clause. Mostly, the other part to this is that how can I say that and even a turnover, a small turnover of ACP threshold is very low. There is an ACP, but my first task if I am advising a player to my client on the TDS side, I can ask, I take an ACP declaration as well. If not, some expensive way to say that there is a limited commercial activity that takes place so that if there is a TDS thing to a player and he gets questioned by the director, I say that I can take a manner and therefore he should not hold me responsible for the operation. So this is one practical takeaway on the PE aspect. I'll pause here and answer any comment question. Right. So the question is certainly what kind of consideration I think on this aspect. Department gave it a bit early, based on the rest of the country argument. So which were from a legal strategy standpoint, there are some open loopholes over here. Also in what capacity there was a contract, right? So, I had obligations that the contract to run the project, and they were not coming to enter the service, but it was their own obligation, etc. It was a point where the department did not go for it. Okay, we have 10 more minutes left. I covered 5 minutes on other form, distribution tax, and 5 minutes on software taxation, related aspects. Before we close session, other form, all of you are aware of this matter. The responsibility. Anyone who is enter the other form of that is fine. This controversy is related to the taxation of the dividends. Before we come to the table, let us just go back to the basics around dividend taxation. We have seen a change in the dividend taxation philosophy for the dividend of taxation and the non-resident. Then came the distribution tax where the company is paying the tax and not is exempt in hand to the shareholder. Now again, we have a situation where EDP has gone and dividend is now actually in the hands of regular shareholders, and this particular is complicated promoter in the context of IRS and but dividend, especially in the era when dividend was taxable, dividend was subject to the distribution tax. The tax was being paid by the company at a effective rate of 18%, right? And why company dividends? Because it was easier to collect the dividend from one company rather than from other shareholders. That was a rationale. Now, foreign companies which have subsidiaries, they are subjected to the distribution tax. Now, foreign companies, when they invested into the Indian company, they found a tax treaty, and most tax treaties say that the dividend under the treaty is taxed at 10%, by tax. So, if I get dividend from Indian subsidiary, it could be taxable at the rate not more than 10%, it was 80,000. That's a reasonable expectation that foreign company had under the treaty in my mind. When treaty came, effectively the tax was paid down from 10% to 19% because in a way the Indian company was crossing the actually more than 80%, 19%. Indian company, if I was to receive $100, I have paid 10% tax for, but now Indian company is taking 20 out and it's only taking 80. Effectively, my cost went up. That was problem 1. Problem number 2 is that because it is a TAT paid by the Indian company, foreign tax credit my own jurisdiction becomes a challenge because earlier it was a 10% TAS, which is available as a credit. Distribution tax is not available as a credit. So it was again a double money in the DDT regime. And some companies, before we get the tax controversy, I just traced the history of dividend taxation since 1962. Initially, for a good period of 25 years, taxability had for shareholders. Then a brief EDT period for 5 years. Then again 1 year EDT was established, dividend was reintroduced. Then there is a sustained period, up to 2014 when EDT is there. Then EDT equal to the EDT crossover. That's how the law was evolved. And now EDT is abolishment dividend taxes on the shareholder. Now, last 50 years, India in its domestic law kept changing how dividends are taxed. From a foreign shareholder standpoint, the tax treaty what we promised the dividends are not subject to taxation beyond 10%. So particularly foreign shareholders took this plea that what you do on the domestic law side should not affect my commission. And therefore, a few companies say that even when we calculate the dividend tax, the companies take the DDT should be calculated as per the treaty rate and not the 18% domestic tax for it. That's the root of the controversy. supplementary tax and dividends. But a continuous USA certificate is we will not have to be credit in USA. From an ATS standpoint, most of the ATS come from the key 5 jurisdictions. Now the key ones we not allow the ATC operating in India. So color code, Bombay High Court, the Goa Bank judgment, which said that it is effectively economically a tax on dividends, and therefore the rate of DDT should be as per the DD, and DD paid over above the tax should be refunded back to the taxpayer. This has been the plea from the other committee with Bombay High Court division bench accepted that view. Then there was another matter of a company called Prosecco, which in the matter of 15 months their judgment came out. Because as an observer, I can really think that you have one division bench judgment which says that fine, we are releasing the taxpayer. Same facts, another division bench, either the ideally division bench is not covered the division bench. Department preferred something to Supreme Court, so if you department the problem against the division bench, you have revenue available to Supreme Court. Now here what department has done is that there is a second matter in possible case for judging. Department said that other than post judgment, division is not a right law, therefore it is a parliament. And to my surprise, Bombay High Court accepted the case and constituted the argument. Incidentally, there is some, I hear that the same bench has referred another matter of the Goa division to the argument that we will find out what are the things behind the scenes. But in the Bombay High Court said that we will continue the argument. All of this was happening when SLP before Supreme Court, I think the first judgment was pending before Supreme Court. Coincidentally, around the same fortnight, the matter came up in Supreme Court. Moroscata is the argument the matter of the Supreme Court. Moroscata said that before Supreme Court that Supreme Court should admit this and post it for early hearing. Don't wait now for the Bombay Court arguments to the Bombay Supreme Court has completed the nothing and is posted for his post petition. So now, here is the division bench Supreme arguments before Bombay Court even when it is redundant and Supreme Court will hear one side for all view that whether the DDT refund should be, DDT should be, and the DDT refund as per the domestic tax law right now. Forget the commentary and the narrative behind the review of whole year, including in that sense. What is key takeaway for all of us is that media was an Indian company, which are subsidiary of the foreign company. If there is a DDT which is paid and the DDT rate is lower, can you consider making an application based on the comparative judgment, which of course is now the status of the division things is a question mark because there is a question mark. But the question is that can you, for example, belong to Hyderabad jurisdiction, can you put a claim before the tax offense that there was an instant that is paid to grant a refund? The section 230 to 134 is one section. Refund of taxes, and RRC is allowed to make an application for the refund of taxes paid under the tax law. That's only one language section which is there. There is no time limit given that section. So, theoretically, if I can make an application before the officer, of course it is not grant for me, but it keeps my claim alive. Suppose tomorrow Supreme Court that when we go in favor of the taxpayer, I have a window say that I have to already my claim to the tax officer for the refund of this 80% minus 10% extra revenue distribution tax rate. So this is the takeaway from the other concept. Supreme Court does 8% year-on-year, that's a significant amount. Anyway, so I will skip the MFN or I will come to the software. There is a 5 minutes. I just want one or 2 minutes on you all know the MFN, again, taxation, it was argued that by applying the MFN terms in treaty, a lower rate of dividend taxation should be applied for. That was some of the companies argued. Finally, this was a treaty involving Switzerland and the Dutch treaty, where the treaty said that if India enters into a treaty with other country where the rate is more beneficial than the current rate, that rate is applied. And India entered into some of the last years in the last 10 years where the rate of dividend was lower than 10%, 5%, 5% actually. Report said that MFN clause cannot be applied automatically. There has to be a specific notification only then the MFN will be in. Taxpayer said that no, MFN should be applied automatically because wherever there is specific language that we need for the implicit application, that causes application that is the twist. But then Supreme Court said that MFN will not apply automatically in this case. That's the name of it. This judgment is in the context of dividend. I mentioned at the beginning, we all have been applying more withholding tax rate or the definition of being available definition, especially in the context of some of the treaties by other definitions clause. It is higher 20 years that several opinions apply the definition clause for the royalty PX super well. In terms of the Supreme Court judgment, even those, and there are more tribunal rulings also. Yeah. These are many where which stations MFN are applicable is there the treaty with Netherlands, is there the treaty with France, the India France treaty is being modified as you speak, but for the last 20 years, I think these two treaties where India does have a lot of trade, where MFN was being operated. Then there are treaties like Estonia and so on. But these were the main ones last time. Next one, France, Netherlands, Switzerland. Even Sweden, actually, is Swedish company. So this is one key change. Again, I don't think what the issue is. This is for the past boiling FTA experience that we have taken. They are that only restricted for regulated taxation where the case was the case, but I see this also as a potential risk area of competition. And last but not the least, software taxation. How many of you issue 15 CSCB for software payments? Many credit cards. For everyone or no? Yeah, so software subscriptions is a big issue. When there is a payment for software subscription to a US entity or a RRC entity or an Indian company, especially with experience applicable. Google has now moved to corporate subscription to India and they actually accept 2% periods. Google accepts earlier 10 years back, the Google subscription was an island entity that was there. They changed their business model. Now you go to Google India entity and they accept 2% periods as well. 2 or 10%, whatever it is. But some of the AI subscriptions, etc., and many other many businesses, big software payment. Is TDS applicable? Audit is always a million dollar question. And the view that has been so far taken and accepted is that when I take a software, I don't pay the IT in the software. I only get the user rights in the software. So I don't pay for the royalty for use of. I don't pay the IP. I'm not paying for the IP. I'm not paying for the copyright. I'm paying for the copyrighted articles. So when I buy a J.K. Rowling book of Harry Potter, I don't pay the IP of the trademark of the Harry Potter book. I only get the book, which is the copyright material, which is the limited user right. And this is not royalty under the tax treaty. This is what OECD has said. This is what engineering analysis, Supreme Court also said, though it was the context of a trademark software, the CD and so on. But effectively, most of the software arrangements are that you get limited user rights. Now, only if you are a distributor, then it's a different story where then you look at the case-by-case basis. So, engineering analysis, Supreme Court, this is the only judgment in the last 5 years, which is a significant one, and in favor of the taxpayers. Made of copyright article, and under the treaty, this has been under the treaty, number of tribunals, courts have said in favor of the taxpayer, the TDS doesn't apply. In between, equalization principles of the state and equalization maybe India will do last year. We hope to get a deal with US with this term. India decided to go to taxation on equalization maybe. Maybe it's still not on the cards, but anyway. So far there is no issue. When I go to the tax office, the TDS officer they will they try to do distinguish between analysis and they try to getting the TDS order software. But at tribunal level, there is not technical judgment that's coming through. The other way is that if it's a group company structure for software, so I have a parent company in subsidiary in India, we were expected to structure a contract where I got this particular royalty and I deducted 10% period so that I have to mitigation for 90 on my end. And because the clauses are such that it triggers royalty in the home country jurisdiction, foreign tax rate is available. Finally, I need a zero risk solution and not the perfect solution. In case of startups, however, they don't have profitability where then the NTC becomes a problem. But large established businesses, this risk of 10% is quite a high risk. Sometimes software distributors and margins are less than 10%. So if they get 10% ES notice, their entire business profit is wiped out and the tax mitigation. So, his question is TDS section 195 because it's a very good non-resident. I'm talking about cross-border software. Then TDS is to be done with the accepted. Yeah, implementing was here and here. The 194J, the software is covered under J. And there is something also on 194J software that only at one level there is a TDS. After first level, for subsequent level of distribution, there is no multiple discount. 10% will eat up on all the markets. So that's it from my side. The evolving things, like I said, the topic that we were evolving data, whatever numbers, I thought these are two other important themes, significant ones of the impact tax, which are there in the, here it is, trade war is impact on the treaty interpretation is certainly happening. Withdrawal of the equivalent treaty is one. India-France treaty negotiation is also, has also happened as a part of the larger topic of the trade between India and less development content mostly is there. Digital taxation and software taxation, there will remain a problem and from the withholding tax interpretation standpoint. Thank you so much. Thank you again for this that points and it's and we also say that and talk of and that's good.
Though everyone have it, everyone have it in the check.
Do you have a case study open in front of you?
Full to get
We can wait for a couple of minutes and then start. Let's get out. 10:47.
केस स्टडी है वो चाहिए वहाँ पे केस स्टडी इसमें डाउनलोडेड है तो मटेरियल ना पूरा मटेरियल डाल के चल खोल लीजिए तो वो नहीं चेंज कर देगा connected phone. नहीं हाँ मैंने दिया हुआ था इसमें चेक करना पड़ेगा इसका नाम पे डाल के बस
हाँ तो क्या व्हाट्सअप
The way the case study has been designed is this compliments to the person who designed the case study. I don't know if he's present here.
No, he is not. He has left yesterday.
Okay. Alright, so we'll start Bharat with leaders into the case study. First, read the facts because there are a lot of facts. So we'll get to it, but we'll read it together one more time. And then get into the specification. Right?
You all. So, read this just to try to understand the answer. You see, this question is very common to people now because most of us and most of our banks are not outside India. Let's say the US market and when you buy any stock in US market, when you sell any stock, how the family is calculated, and what rate it is calculated, and what holding period is there. This is basically the subject matter. So let us try to read this case study. So there is an individual who's an ordinary resident in India. So just like us, and he was employed with a subsidiary of a different party, having income, and he also has a back in India. He's been running strategy. So he was allotted a 1,000 stock of company A in the year 2014-15. When the market price of the share was given, which is equivalent to 90. So, the value is 90,000 and was allotted, also allotted same number in the previous year, 2015-16, when the market price was $22, but the INR got depreciated and the value was depreciated. Basically, not like this one. The value of the company is the rate of the stock was added to his salary
तुमको भेज सकता है
as 90,000 and so the person has paid corporate tax on that, so that becomes part of the cost. At the later date, stock again was vested in 2017 and 2018. Within the vesting period is very, very important. Whenever there is a stock option, there is one granting and then there is vesting. So we need to understand what is vesting and what is granting, how the cost is arrived, and when does the cost arrive. And during the vesting period only you get the right, full right of the share, then you sell that. So during the vesting period, the price per share was 23 and 24 respectively. Now, this share will park at Morgan Stanley into a demat account. They will be broken. They will use that into those shares. If the client account and the withholding tax was also deducted every quarter, and they used to issue a statement also. Now, in the previous year, 23-24, on 23rd of April 2023, the SEC sold 1,000 shares at $5 per share. At the equivalent INR, so basically the equivalent INR is 400 per share. And always getting calculated $5 US is the client account. Which means the amount was credited back to the bank account immediately, and the bank credited 4,10,000. So basically there are three things. The shares were sold on 23rd of April at the rate of $5, and 5,000 rupees got credited. That time, equivalent 5 rupees was equivalent to 100. And the share and the amount got immediately credited back amount of the company. More like that. Similarly, SEC sold the share in 1,000 shares at the same USD rate of 5, but however in February 2025, the share was sold on 2nd of May 2024, and but ultimately came to its value on February 2025. There was a delay of 90 days or more than 180 days. So there has to be some indication of that also. We will understand what. So let's start the group discussion. So what do you think? What should be the period of holding for this share? Let us see 23-24 first. How do we calculate the period of holding? Number one. And what would be the tax rate? So this 23-24, that time the tax rate was 10% for long-term capital.
Yes, more than 10%.
Yeah.
And the benefit is more than 10 now.
So maybe in a day or two, again the rupee got depreciation and they call it extra. Could be. So we'll assume that if there was a depreciation of rupee and you got 10,000 rupees in those two ways. So what do you think? What would be the period of holding? Whether it is a listed share as per India or unlisted? How do you determine the period of holding? Why unlisted? Because listed is not property. Okay. So it was unlisted as per the Indian constitution. So when it is unlisted, so how do we determine the period of what is the period of holding for to qualify as long-term capital? So from where do we calculate the period of holding? The period of from where it was allotted or from yes. So when was the first vesting happened? Okay. And when was the share sold? 23-24. So there is a period of more than 2 years where it qualifies as long-term capital. There is no doubt about it. Okay. For the second tranche also, it is more than 2 years. So the tax rate will be at that point for 10%. But 10% was for 10% was for shares where STP was अभी 12.5 हो गया from 2024. This period is for 23-24 financial. So that time the tax rate was 10% or 20%. 20. I know. The taxation was available or not? 20 with indexation. This is also clear. Okay, I will clarify that here is no DA impact because we are talking with an Indian resident selling a share. So, DD benefit is typically available to a non-resident. Not, but also there is a withholding in the overseas jurisdiction to that effect. Benefits will not be available if at all. Tax will not stay. So not really, it's a domestic law issue in this case. So, the first question is whether the case is locked up. It is a lock-up from non-listed entity. It is the working period is more than 24 months and the tax rate will be 20% with indexation. Before we move forward, just one observation over here. I mean, I agree with the conclusion on this of the group over here. This definition of exchange security, as you also the definition refers to the listed in India. So listed outside India is not listed for India purposes. So this is one important point. While of course now the tax rate distinction has gone effective July 24. So to that extent it remains academic, but there is one takeaway in the ESOP valuation. In the ESOP valuation, foreign listed shares are also subject to the merchant banker valuation.
See, if it is a listed share and you're doing a ESOP perquisite tax valuation, there is a very tight date of what is a fair value. But if it is a overseas listed share, then it is regarded as unlisted. The moment it is unlisted, I can take a merchant banker valuation report, and rule allows me a flexibility around the date of the merchant banker valuation report. Sometimes even a 5% variation within a threshold period of 6 months matters, especially for the perquisite tax calculation, because it's a straight away TDS on salary. So for foreign listed shares using merchant banker valuation, you have some flexibility to decide how much is the fair value for the perquisite tax calculation. That's all is a takeaway I want to mention. This is not a matter for the case study. Because we touched upon listed shares, I thought I should give this additional input that even today for the ESOP perquisite tax calculation, there is arbitrage available on the number of days up to which you can go back and take a merchant banker valuation report. That's the only takeaway for all of you, here. Sometimes the 5% variation and a right date can bring down the effective TDS on salary perquisite. But it also reduces the cost also. So there are 2 points. Perquisite is taxed at 40%, 39% today. A lower cost of acquisition means higher long-term capital gains tax, which is taxed at 15% and that too later, not today. So there is both a absolute saving and a time differential as well, which is available. So yes. On sale of shares, will be the TDS? Dividend understandable, but I have never seen TDS on sale of shares in US especially.
I'm not very sure whether it's not capital gain or certificate tax certificate and even the name of tax certificate. That
Yes. Yes, that FTC, again, there are 2 kinds of taxes there, federal tax and the state tax. And only the federal tax is available.
that credit is available for
That it is available. Bharat raised a question on credit. I know we are digressing from the case study. We'll just deal with this and move back to case study. Federal taxes, certainly credit is available. There is a Karnataka High Court judgment of Wipro where even state taxes have been allowed as a credit. So this position also exists from a FTC standpoint. You can move forward. But I have not seen TDS on capital gains. Dividends, yes, but not on capital gains.
Right. So we'll move to the next question. So how do we calculate the gain on this amount? So there are 4 options given. Difference between the amount credited to Indian bank account, which is 4 lakh 10, less value of perquisite considered. So the perquisite value of perquisite, let us assume that it was 90,000 in 2000. So on 17-18 it was 90,000. So how do we calculate that? Amount credited to Indian bank, first option. Second is difference between the USD sale rate to USD allotment rate considered at the time of adding perquisite value. The third option is difference between INR of sale consideration on date of sale to INR of perquisite value. And the fourth is difference of selling rate in USD less rate in USD as of the date of vesting. So how do we calculate this capital? So any other view? As per Mr. Shah, it is third. Difference between INR of sale consideration on the date of sale to INR of perquisite value. So now 4 lakh 10 minus 90,000. 4 lakh minus 90,000. Okay. Any other view? For an Indian resident, this dollar need to be converted in INR as per the last month TT value, if I'm not wrong, or on the date of
I have a slightly different view for us, but I don't know internet.
So the dollar need to be what was the transaction value of INR on that day? So that has to be calculated. That the difference will be the capital.
Okay. Yes.
Yes.
But
In INR.
if I could just step in, sir, I agree with this thought. Let me jump to the. So there is one view which says that 4 lakh minus 90,000, 4 lakh 10,000 minus 90,000. The classical INR way, the way we do it for the P&L, so to speak.
Right.
That's one way. The other way is that you do the dollar to dollar gain and then convert. That's the other view. Is there any other third view available in the room? Okay. Yeah. Okay. So, Bharat, if I could sort of give the background. So, first of all, let's just go to the ESOP part. In my reading, ESOP taxation happens at the time of exercise. So there is a allotment, then there is a vesting. I eligible for ESOPs after vesting, and then there is a third stage which is actual exercise and allotment. India is the only country where in India this is the only example where India is following the leniency in taxation, where taxation is deferred at the time of exercise of the stock options. At the time of allotment, at the time of vesting, there is no taxation in India. It is deferred up to the actual exercise of the point. So here, just one aspect of the case study where it says that perquisite tax was paid in the year of vesting or is probably incorrect, but this is again not a moot issue. When the ESOPs were exercised, at that time the perquisite tax would have been applicable, and when I exercise at that time the shares get allotted, so which means my acquisition of share becomes the date of the exercise stroke allotment, assuming both are the same. So while calculating the holding period, my vesting period has no relevance. It is the date on which the actual allotment happens, that is my date of acquisition as far as I as an employee for the shares are concerned. And here there is a sufficient period, it is more than 2 years long-term asset. So this is clear. Now when we come to let's come to the capital gains calculation. Now what has happened? I bought the shares when they were $2 per share, or that's the perquisite tax I paid, and I'm selling them when the price is at $5, and I'm converting some rupees, whatever based on exchange rate. There would mostly be the gain, given the way the dollar, euros have moved in the last 20 years. But if there is some other currency where rupee has been stronger, you could get a different outcome as well. For fundamental principle, this is a sale of an asset, sale of a share, which means it is covered by capital gains, section 45. Section 45 says that there is a sale, extinguishment, etc. So section 45 gives a very specific calculation methodology, which is different from section 28, etc. It takes me to section 48, wherein full value of consideration minus cost of acquisition minus index cost of acquisition is how I calculate the capital gain. Am I right? ICDS doesn't apply to the capital gain calculation. This is again important because this is an employee who is holding this as a capital asset and an investment. Now, for the purpose of section 48 capital gain calculation, there is a specific rule given, rule 115. Okay, rule 115, as you rightly mentioned, gives different heads of income, and for each head of income there is a different specific date which is given. So if it is PGPP, then with rule plus ICDS make sure that forex gain losses I convert in a way, I do it in accounting standard and it's taxable. But when it comes to the capital gains, what rule 115 specifically prescribes is that I will calculate the gain in dollar to dollar terms. So $2 was my purchase price, $5 is my sale price.
I will first calculate the gain in dollar terms. This is 48 read with rule 115. 48 read with rule 115. My gain is $3.
5 minutes or 5 minutes.
5 minus 2. 3. Logically, it should be 3 vesting half. But the perquisite tax was deducted at 2. So whatever is the, I mean, like I said, 2 or 3 over here, the facts are the way the taxation happened. It should have been at the time of actual allotment. Should be 5 minus 2 because my cost is 2. Okay, so sorry, we may agree to disagree. The way the perquisite taxation works, it is at the time of exercise of the option, which means I exercise it when the shares get allotted to me. The vesting period will happen over a 2-year, 3-year period before. That vesting period is not relevant. Okay, so for new, let's not get into the ESOP taxation. That is not the moot purpose of the case study. The principle is that it is at the time of exercise, and exercise allotment typically happen together because I exercise and then the employer allots to me. The period of vesting before that is not relevant. At the time of exercise, if I had paid $3 or $2, whatever is the case, that is my cost of acquisition. So can we agree that for example purpose, let's treat this cost as $2? Okay, so that we come to the main issue on forex gain. Cost of acquisition is $2. My sale price is $5. So my taxable capital gain is 5 minus 2, which is $3. Is everyone okay so far? Now Rule 115 says that states that the month in which I sell the shares. So let's say I sold the shares in April 23. So as of March 23, whatever is the SBI TT buying rate, as of 31st March, you will apply that rate to convert this gain into the taxable INR amount. So $5 minus $2, $3, multiplied by whatever is the exchange rate on 31st March. Previous month closing is the date on which I will calculate the capital gains. This is what Rule 115 says. The same rule is carried over in the new Income Tax Act as Rule 206 now. They have just converted text into table, but principally, fundamentally, there is no change over here. So, what we have here is that my taxable gain are now frozen to an exchange rate as of 31st March 2023. So the day when I actually sell, which is 23rd April, and thereafter there is another instance of actual remittance back into my Indian bank account. To my mind, both those exchange rates are irrelevant for capital gains calculation because, again, capital gains, section 48 tells me I have to calculate the gain in a forex, and Rule 115 specifically tells me that I have to take an exchange rate of 31st March 2023. All other actual exchange rates for me are not relevant as far as the capital gains calculation is concerned. So in my view, in this case, the capital gain will be so whatever. I mean, 31st March का जो exchange rate था, right? So $3 multiplied by that exchange rate will be my taxable capital gains amount. Now there are 2 or 3 other limbs which I wanted to cover, which are related to this. Why I say this provision is unique and important is because capital gain and rule gives me a specific calculation. If it was a business asset, like if the shares were held as a trading asset, then I would have done a mark to market on a yearly basis. Forget actual sale, I would have done assuming it is a monetary asset, which is actually the alternate scenario. So on a year-on-year basis, I would have done a mark to market. Here it's a ESOP, so it's a different scenario. When I actually booked my sale, at that time there would have been some gain, and then there is a gain upon final conversion. At all stages, when it comes to profits and gains of business profession, rule along with ICDS, I would have taken the actual real INR value, but when it comes to the capital gains, I do the dollar to dollar calculation. What is the benefit is that the rupee depreciation impact effectively is taken out. So in this case, when I bought the shares at $2, the exchange rate was very minimal. Today you are effectively, if this rule was not there, you would have taxed me for the rupee depreciation. Economically, I never earned that money because it's a currency depreciation that has happened, and which is why the rule is saying that you take out that currency appreciation or depreciation impact. When I do the calculation of 5 minus 2 or 3, it automatically takes place. So 90,000 and 4,10,000, which is a view. Effectively, it has two components. One big component is a rupee depreciation, which rule takes away from the capital gains calculation, and then this aspect. Now there is whoever framed the case study has chosen the date of the sale as very interesting. This is before 23rd July 2024. What happened in July 24? Indexation went away and tax rate got modified, and we have now a common holding period. This sale has happened before July 24. Now, let's now spend few minutes on indexation. Who is eligible for indexation and who is not eligible for indexation? If a non-resident invests into India and is selling the shares, even he does a calculation in a dollar to dollar term, but he doesn't get the benefit of indexation. He never got the benefit of indexation. Here, who is the seller? The Indian resident. So when an Indian resident is selling, an individual selling is, to my mind, he was also eligible for an indexation benefit because there is no restriction in section 48 proviso to a resident claiming an indexation benefit. So in this case, my capital gain will be $2, and I do the capital gains indexation, year of sale, year of purchase. So let's say that $2 becomes $2.60 and my sale price is $4. So my taxable gain is 4 minus 2.6, 1.4, and I convert that based on the 31st March exchange rate. This is a double whammy or a double benefit that I am taking the currency depreciation out, and you are also giving me an indexation which is in a way for inflation, which is a concept of indexation. To my mind, this is an unfair provision. It's a lacuna, but which in my view is beneficial to the taxpayers. So effectively my taxable gain will be 4 minus 2.6. Taxable capital gain for income tax return purpose. What I actually receive is 4,10,000. That's not a problem. This view is actually also upheld in one Mumbai Tribunal judgment case of Havels, India. I think your study paper also refers to citation, but those who don't have, I can give that citation. It is one minute. I'll just Havels, India versus ACIT, 5/20/2020. It's a 2020 judgment. And thereafter, one of the Reliance Group companies, I think Reliance Group companies has also a favorable judgment is there, approving the same view. So, in my view, in case of capital gains, it's an indexation plus the latest exchange rate is how the calculation will happen. Yeah, Delhi I did. Sorry, let me give the citation. I could have. Yeah, I'll come to this scenario in case of companies, how it would work. For ours, the Delhi Tribunal, it is 123 Taxman 263, and there is also Reliance Energy 2006 judgment 103 ITT 223. These two put together give give a view, but even without judgment, based on a plain reading of section 48 and rule 115, there is no iota of doubt that indexation and rate appreciation benefit will not apply. So, okay, so now let's look at what happens to the actual exchange gain, and here at least the case study speaks of an individual. He is not required to maintain books of accounts in that sense. He will receive some amount in his in his bank account, which is higher than the income offered to tax, so to speak. But that is where I have to explain the calculation provision. That gain in this case is not taxable in his hands because it is covered by a specific charging provision of capital gains. Now there is also a point that some of the judgments were given pertain to a period when section 56 to 10 was not there. So the issue is that can AO say that 56 to 10 applies to the gain component? Fine, you paid the capital gains tax based on a specific methodology, but the excess gain, is it is it another income? There is no judgment, but my reading is that, as you know, section 56 is a residuary provision. It applies only when certain income is not covered by any other taxation provision. And here there is a specific, this transaction is covered by capital gains, and therefore section 56 per se does not have an application to this proposition. There have been some old judgments which said that foreign currency itself is a capital asset. If it is held in a capital field, then it is a capital receipt. If it is held in a business field, then it's a revenue receipt. So again, in the context of individual, certainly the gain is not taxable. Now let's come to in the context of a company, and I had an occasion to deal a couple of times. I'll explain the factual background. Indian company invested in preference shares of a UK subsidiary, and the UK subsidiary redeemed the preference shares after 10 years period before July 2024. Now here when I calculate the P&L as per Ind AS, I have to account for the entire gain to my P&L account. Okay, are you with me here? Okay, it will come as a P&L credit as income. When it comes to the normal taxation, the capital gains, based on Rule 115 as well as Section 48, I will calculate the capital gain which is based on indexation first, because again Indian company is eligible for indexation. This is a period before July 24. So my income chargeable to tax under the head capital gain is much lower than what is credited to the P&L account as my income. Okay, so this is point 1. So in my normal calculation, I will add back the forex gain, saying that it is covered by a specific chapter on capital gains. Then when I come to the capital gain schedule, I will show my Rule 115 calculation and offer the income as taxable capital gain after indexation. Now for MAT purpose, what is the issue? So in this case, here is an individual, so he is not required to maintain books of accounts. In company's case, there is a forex gain sitting in my P&L account. When I do the PGBP calculation, that forex gain is occurring on account of a investment in preference shares. It is not covered under PGBP. It is covered under the candidate capital gain. So I remove it from the profits in the normal PGBP. In capital gains, I show indexed capital gain using dollar to dollar. I mean, in my example, it was a euro investment. Had it been a business asset, then forget if it was a business asset or a stock, not even till the sale, on a year-on-year I have to do a mark to market in my P&L, and that becomes my normal trading gain. 115, in fact, says key for business on closing day you convert. ICDS also is clear about it. Now 43 post ICDS also, one of the 43 CA sections also gives a credence to that point. So my trading income is taxable. For MAT purposes, however, this gain will be a taxable gain because in MAT I don't have a flexibility to touch my audited P&L account. So this is the view in substance as far as the case study is concerned. So after amendment, now the indexation benefit has gone, but for individuals as well as for companies, this dichotomy will be there because in books of account, I would have recorded a original investment at let's say 2010, 11, 12 exchange rate price. In books, I credit the gain at in a rupee terms. But when it comes to the capital gains calculation, I do the Rule 115 calculation and then offer it to the taxation purpose. This is for individuals holding overseas investments as well as for Indian companies that have invested in equity shares or preference shares outside of India as well. So this is it from my side.
So, we come to question number C. So, in case of answer is 2 or 3, what is the treatment of difference among C? So, I believe Amya has already answered that. So, moving to the next question. In case of sale of 2024, the sale consideration was remitted back after 6 months. So, there could be a violation of FEMA here, and the bank has issued a show cause notice. So, is the notice valid under FEMA provision, and what is the remedy?
Any FEMA gurus here want to answer this? I mean, there is a violation after 6 months.
So you have to bring back the fund to India into your account, in your bank account. So the fund was remitted in February 25, but the sale was done in May 2024. There's a clear delay of more than 6 months. The bank has correctly issued a violation notice, show cause notice. So there has to be a compounding application which need to be filed with the RRC.
Practically, many of these employees working with subsidiaries of American companies, they sell this money, they sell this ESOP, they never bring back the money, it gets immediately deployed. I mean, we don't even get to know, and is this okay from a FEMA standpoint? I think if there were ESPP, that is shares purchased where some consideration was given, like nominal amount, I think there is a view from RBI, and you could reconfirm RBI practices also vary from city to city and AD banker to AD banker, but if the consideration was paid, if some consideration for acquisition was paid, AD bankers are okay if an employee reinvests back into the overseas securities as well. Reinvested. Otherwise, you have to bring it back and it has to go back under LRS.
So now let us reverse the situation. If there is a returning employee and he is already holding some US stock and he has come back to India, now it is more than 3 years. He is living in India, he is a retired employee. So in that case, is it necessary for him to bring the money, remit the money to India within 6 months?
So I give the answer. Answer is no, he doesn't need to bring back because he acquired these shares while he was a non-resident under FEMA. It is an asset which he acquired, a foreign asset which he acquired while he is a non-resident. So there is a grandfathering to such assets to returning Indians that they do not need to bring money back into India after the sale. So maintaining innovative fund flows or bank statements is very crucial in this case because after some point money is fungible, right? A person, he comes back to India, and this I'm saying from a practical experience. Let's say he came back 3 years ago, now he's become a resident. As a resident, I can send under LRS $200,000 every year. Let's say it has gone into the same brokerage account, $200,000, $200,000, and in the third year he's selling some amount. How do I identify that this portion was out of the money that I had as a non-resident
and this sale portion is now out of the money that went under the LRS. So here, at least I suggest to the client to maintain two separate, especially for returning Indians, to make sure that there is no iota of doubt. And with RBI, as you know, it's better to be completely watertight and be as clear as possible. So I recommend you have two brokerage accounts, one which covers the legacy investment. So all your sale and purchase of while you are non-resident can be kept intact, and the money that is going out under LRS after you return, keep it in a same bank account, so that there is no doubt. This is from a FEMA hygiene standpoint, and even in CAs, recommended is to maintain the two set of books of account, one for the legacy investments held as non-resident and one for the new investments. It helps in tracking these compliances from a FEMA standpoint.
Right. And they should have all historical records where the fund was invested, because it happens that when they come back to India, it is very difficult to track. And the first question the income tax asks you, what was the original value when it was invested? So it is very important. There has to be a proper planning for all analyzed when they come back to India.
Okay, so that's it. I think those were the business investment I already dealt with in the case study. We are good. It's 11:30 on time. Thank you so much again for your participation in the case study. Thank you, Mayur, for having me here as well. And thank you to Bharat for leading the case discussion. A big hand for him too.
Thank you, Anya. As I was mentioning that a lot of people have helped us in collating data and supporting us. There are few members who have not been able to click to the program, but then they were supporting. So one of them was CA Vijay, because they went and recommended us Amya's name, that is very good, and he has connected us with. Thank you so much, Amya, for taking us through all simply detailed thing. I think everyone was grasping each and every aspect which we are talking during the presentation as well as during the group discussion. Thank you, Bharatji, for leading the group discussion and taking us through. Friends, will be taking a break of 15 minutes and then rejoining for last session. We will be summarizing two more group discussions which we will have after 15 minutes. And in the break, we hand over the certificates for the members who we are not yet able to keep. So those who are still pending will hand over the certificates. Our last faculty, somehow has not been able to join. So here, he's sending his partner, one of his partners will be joining, and he will be taking the summarization of two courses. So we'll be breaking and then. Friends, one more thing, इस तरीका का जो RRC होता है, I'll say beyond technical things, we believe in lot of fellowship also and lot networking होती है. So one such example, I was telling that we have done one such RRC in Jaipur also, first president heard me. So one of the delegates of Jaipur RRC was from Hyderabad, Miss Ankita. So she has thought that we come back and we talk about it. So she was saying in Jaipur RRC, she was a delegate, she went from Hyderabad to Jaipur to join the RRC of EIRC. And then she's here today, she lives 1.5 hours from COE, but she thought she will come here, meet us and all of you as well. So thank you, Ankita ji. I hope that the network among the delegates of this RRC also continues, and will continue the group and will continue sharing our knowledge and helping youth by others. Thank you. We'll be doing the felicitation of returning delegates.
देवराज जी बाकी सर्टिफिकेट्स ले आइए.